Hello billionaires in the making, and welcome back to our channel dedicated to wealth creation and smart investing. Warren Buffett's investment story began at a very young age. At just 11 years old, while most kids were busy with cartoons and video games, he was already dabbling in the world of stocks. Imagine that level of focus. As a youngster, Buffett experimented with different approaches such as stock timing and even chart analysis. Although these early attempts were more about curiosity than profit, they laid the groundwork for the disciplined strategies he would later develop. At this point, I want to hear from you, billionaires in the making. Did any of you start investing or saving money when you were young? Drop a comment and share your early experiences. And if you find these early life lessons inspiring, please hit that share button so more future investors can learn from Buffett's journey. What's truly remarkable is that even as a novice, Buffett understood one key lesson. Even if he didn't fully know it then, education was his greatest asset. He wasn't just following the crowd, he was questioning, exploring, and always learning. Remember, every great investor starts somewhere, and your journey is just as important as the destination. After his early experiments, Buffett dove headfirst into learning. He spent countless hours in the public library reading everything on investing he could find. It wasn't just about reading popular trends or mimicking others. It was about building a solid personal framework for decision-making. This period of self-education is something every aspiring investor can relate to. Think about it. When was the last time you read a book or article that fundamentally changed your perspective? If it's been a while, I encourage you, billionaires in the making, to pick up a classic like Benjamin Graham's. Speaking of which, that leads us nicely into our next segment. But before we get there, please like this video if you believe in the power of self-education, and share your favorite investment book in the comments below. Through his persistent study, Buffett learned that understanding a business was far more important than merely following the trends of the market. This foundation of knowledge would later become the cornerstone of his investment philosophy. And it can be yours too. At the age of 19, Buffett discovered Benjamin Graham's, a moment that transformed his entire outlook on investing. Graham's teachings introduced him to a core set of principles that would eventually evolve into the 3 simple rules we focus on today. Just a couple of chapters in that book shifted Buffett's paradigm, teaching him that true investing isn't about short-term speculation, but about understanding and valuing businesses properly. Buffett's approach reminds us that investing is as much about mindset as it is about math. I invite you, my fellow wealth creators, to take a moment and reflect, what mindset do you bring to your investments? If the idea of a disciplined, thoughtful investment strategy resonates with you, please subscribe and hit the like button right now. And in the comments, let me know which Buffett saying motivates you the most. Perhaps rule number 1, never lose money. Rule number 2, never forget rule number 1. Buffett's transformation from a speculative teenager to a thoughtful investor underscores the importance of continuous learning and applying timeless advice. And as you listen further, you'll see how these lessons crystallize into clear, actionable rules. Now we're at the heart of Buffett's strategy. The 3 principles that underpin his investment philosophy. Each principle is a powerful tool designed to help you make smarter financial decisions, whether you're a beginner or a seasoned investor. First principle, a stock is part of a business. The first rule to remember is that a stock is not just a ticker symbol, it's a piece of a business. Buffett teaches us to look beyond the numbers and see the actual business behind the stock. This means evaluating the company's products, its market position, and its overall management. When you think like an owner instead of a speculator, you can make much more informed decisions. Billionaires in the making, if you're serious about understanding business fundamentals, show some love with a like and share this insight with fellow investors. Also, comment below. Which company do you believe truly represents a strong business at its core? Next is the concept of Mr. Market, a metaphor that describes the emotional, often irrational behavior of the market. According to Buffett, think of the market as your fickle business partner who makes wildly varying offers every day. Sometimes he's overly optimistic and other times he's downright pessimistic. As investors, our job isn't to follow his every move, but rather to take advantage of his mood swings. Remember, when the market is overly excited or overly fearful, that's when the best opportunities might arise. If you've ever felt overwhelmed by the market's fluctuations, hit that subscribe button and comment below with your own strategies for staying calm during volatile periods. This principle teaches you to remain disciplined, waiting patiently for the right moments to engage. The third rule is all about risk management, maintaining a margin of safety. Think of it like this: if you're crossing a bridge with a heavy truck, you want that bridge to safely support more than just the weight you're carrying. In the investment world, this means buying assets at prices well below their true value to protect yourself against potential errors in judgment or unexpected market downturns. If you appreciate the wisdom in preserving capital, then let this concept sink in, and be sure to like, share, and comment on how you build a safety cushion in your own investments. A strong margin of safety is the buffer that lets you sleep well at night, knowing you're covered even if the market doesn't move as expected. Combined, these three principles form what Buffett calls a three-legged stool that provides a sturdy foundation for any investment strategy. When all three are in place, you have a balanced approach that minimizes risk while maximizing potential growth. Imagine trying to stand on a stool with only two legs. Inevitably, you'd fall. Buffett's metaphor of a three-legged stool illustrates that for a solid investment strategy, you must integrate all three principles. Skipping even one of these aspects can result in an unstable approach that leaves you vulnerable to market whims. Billionaires in the making. If you're committed to building a robust investment strategy that stands the test of time, please subscribe and share this reminder. Comment below on which leg of the stool you think is most challenging to maintain, and why. These discussions help us all refine our strategies and learn from one another. Now that we've laid out the core principles, let's see how Buffett applies them in real-life investment selection. He looks for businesses with an enduring competitive advantage, a sort of moat that shields them from competitors. Classic examples include companies with strong brand recognition, innovative products, or even unique geographical advantages. Buffett doesn't waste time on companies that lack these qualities. Instead, he employs an elimination strategy, filtering out businesses that don't meet his high standards. This laser focus allows him to concentrate on investments that have the potential to be truly transformative. Think about your own investment choices. Are you looking for companies with a robust moat? If yes, then show your support by liking this video and subscribing to the channel for more investment strategies. And leave a comment on what you consider a critical competitive advantage in a company. Your insights could spark a great conversation with fellow aspiring millionaires. Buffett's strategy isn't about sheer volume, it's about quality over quantity. In other words, you only need a few excellent investment ideas to build significant wealth, not hundreds of mediocre ones. At the pinnacle of Buffett's career is his management of Berkshire Hathaway, a company renowned for its rigorous approach to selecting investments. As Berkshire Hathaway's capital grew, Buffett found that the opportunities he pursued needed to be big enough to really move the needle. This refined focus on significant investments is a testament to his evolving strategy of quality and precision. For you, billionaires in the making, this means that you don't need to reinvest every penny into small ventures. Instead, focus on a few well-chosen opportunities that truly align with your long-term goals. If you're ready to apply these lessons to your own portfolio, subscribe now, hit that like button, and share this video with anyone serious about building wealth. We've covered a lot today, from Warren Buffett's early experiments and self-education to the three simple yet powerful principles that continue to drive his success. Remember, viewing stocks as parts of businesses, respecting the unpredictable nature of Mr. Market, and always ensuring a healthy margin of safety are not just abstract ideas. They're real strategies that can help you become rich and even join the ranks of millionaires. Billionaires in the making, now it's over to you. I'd love to know which of these principles resonated with you the most, so please comment below with your thoughts. And if you enjoyed this video, share it with your network, like it, and subscribe to our channel for more life-changing financial insights. Together, we're on the journey to financial freedom, one smart decision at a time. Thank you for watching, and I'll see you in the next video.